Chapter 6 Private Funds. Diversification of risk matters, not just defensively, but because it maximizes returns as well, because we expose ourselves to all the opportunities that there may be out there. Peter Bernstein, Take the Reins. By 2020, with over 1 billion of real estate assets, my company had encountered our fair share of unexpected problems, pandemics, government mandated eviction moratoriums, increasing interest rates, and sky high inflation that increase expenses. I understand that each project has variability, but our investors entrusted us as operators to navigate the challenging market conditions for maximum returns. At the end of the day, my investor sentiment weighed heavily on me and still does. I started to wonder, can I eliminate the risks of one asset by diversifying my deals in a fund model? Or will investors want to invest in individual deals where they know exactly what asset they are buying into? To do a temperature check, I talked with my mid-tier investors, most of whom were in fewer than 10 deals with less than 1 million of LP capital exposure. They had a small number of deals, and a small percentage of their investment portfolio was alternative. They were exposed to real risks from their lack of diversification. When I pushed those investors about why they didn't invest in more projects, more than a couple dozen, and mitigate the risks as the wealth elevator guides us to, I was told time after time, I don't feel confident picking the right deal. How do I know if the deal is good? A fund model I saw would change all that. I created my first fund in late 2022, and it's been a huge success. Investors know they're investing with me, and additional envelopment of accountability that I accept, and that my own money is also on the line. That gives everyone peace of mind. And since the fund is diversified, we don't risk losing everything on one bad deal. What is a private fund? A private fund takes the guesswork out of real estate investing. The same operator picks all of the deals, which means you only need to find one person that you know is safe to invest with. From there, you're set for as many deals as you can comfortably take on. It's infinitely scalable while achieving asset diversification. Incorporating private funds starts on floor 3 of the wealth elevator. A private fund offers anywhere from 8 to 25% annual returns. Depending on the investment prospectus, a fund can also achieve consistent monthly cash flow. To get into private funds, you need to understand what they are, when the right time to shift into them is, and their upsides and downsides. So, how exactly does a fund work? In the traditional investment world, a lot of people don't feel comfortable picking certain stocks, like Apple or Google or Microsoft. They see too much volatility in any individual company. The CEO or marketing team makes one bad move in a cancel culture world, and suddenly your stock is in the toilet. Nervous investors choose mutual funds because they're more diversified and stable. The yield is lower, but it's considered a safer investment. Funds act the same way for real estate. You can also think of private funds the same way you think of ETFs that are targeting a specific sector. Each fund has a specific investment prospectus. Instead of investing in an individual stock or a single syndication, you invest in a large fund that spreads your investment over multiple projects. As of this writing, our income fund is focused on income more than growth. With future funds, we may target value-add growth projects or development projects. Another prospectus a fund might have is only doing projects in certain states, such as Texas, or investing in assets that are skewed towards tax benefits. In the next chapter, I explain how the tax ninjas will use those to suit their personal situations. An example of a fund that is skewed towards more tax benefits is a fund that we've done in the past and we may do in the future, which is investing in equipment. Now, equipment allows us to capitalize on Section 179 deductions, which gives us a heavy amount of losses, which sophisticated users like yourself will work with your CPA to use those losses to drive your adjusted gross income down. Private fund versus REITs. A private fund may sound similar to a REIT, but they couldn't be more different. As mentioned in Chapter 4, REITs are another Wall Street product that charges high fees, but offers limited returns. The average REIT charges much higher fees than syndications, yet only offers about 4.3% in dividends, about a third of the returns out there in some of our more conservative funds. In addition, because REITs are typically publicly traded, their prices are just as volatile as any other stock or mutual fund. Their share prices rise and fall along with the broader stock market and interest rates. Unlike a REIT, we structured our income fund so that investors are paid their preferred rate of return first with no other fees. In contrast to the masses investing in institutional Wall Street firms or interacting with their salespeople, i.e., financial planners, we want to build a relationship with our investors. We are truly partners in these ventures and have our own money at stake too. A lot of REITs brag about their 90% of the returns go to investors. That seems good on the surface, but this might not be the best thing for the health of the asset. A private fund can do what's in the best interest of the asset. That means less money in the short term, but a stable investment that continues the cash flow into the future. So don't be fooled by that narrative. So an example, we replaced the chiller system on one of our apartments with an upgrading piping system that would drastically increase the exit price and be best for our tenants, the real customers. To pay for it, we held back on some investor distributions for a quarter. Such a maneuver in a REIT might not have been approved, and the best decision for the life of the asset would have not been made. And in fact, sometimes we'll actually be buying assets from these REITs who have to make, if you ask me, stupid decisions because the way that their fund is governed. A lot of times those REITs have to go in and out of assets within a certain period of time, and they're forced to sell based on their mandate. And we can come in and buy the asset from them, or that's what we did in a couple of cases, and we find ourselves a great deal at their misfortune. When to move up the elevator? When I was in the basement level of the wealth elevator, I saw my bank account sporadically move up $2,000 to $4,000 every month. After 3 years, I had saved up a $68,000 down payment for my first property. I walked that money over to the bank feeling like there was a hand grenade in my pocket. I was nervous, excited, scared, proud, and happy all at once. By floor 3, the numbers and mindset completely change. Now you might ask yourself, do I want to put $150,000 or $250,000 into this fund? And the decision is a flip of the wrist. 10 years after making that first down payment, I was at the bank again. This time I told the teller I want to cash out $500,000 because I need to move some things around. They looked at me like I was crazy. What the hell are you doing? Selling drugs or something? The teller asked. I laughed. Real estate, actually. I guess you'll have to get your manager so I can wire the funds because it's got too many zeros on it, yeah? I did not tell them that we wired off close to $8 million just a couple of weeks prior, most of which was LP capital, to close a recent acquisition. In just 10 years, my perspective had completely changed. I want you to have the same epiphany. And to do that, you need to get to floor 3 on the wealth elevator. Adding private funds to your single asset syndications is a great way to invest more heavily into alternative investments. And again, that's increasing your percent allocation from traditional investments, which is typically more likely a lot of your guys' majority of your portfolio now, into alternative investments for the reasons I mentioned prior. And while we're on the same topic, this epiphany that I had and perspective change, unfortunately for our next generation, our kids, they will never have this strange epiphany happen to them. They're going to be somewhat given this money. Maybe that's going to be worked out in the next book that I do. This is why we like to get our kids and some of the folks in our network bring their adult children to our events and retreats to get them in this community and get them surrounded like-minded people building their wealth. As we're all somewhat paranoid of the saying, living shirt sleeves to shirt sleeves, 90% of wealth leaves family in 2 to 3 generations. Sure, you give your kids all this money, but if you don't give them the mindset and the money lessons that you're learning here, it's just going to be pissed away at some point. Or just give them this book. Make them read it. The upsides and downsides of private funds. What are the upsides and downsides of funds? The upsides of funds are as follows. Flexibility. Funds allow the general partner to make the best use of capital and to remove some administrative costs related to raising the capital for so many individual deals. The operator can also act more quickly and close faster if they had the capital available and can gain access to better deals that are time sensitive. Diversification. Just as a blended whiskey creates a more consistent product, funds offer more stability. Stronger properties help prop up weaker properties and provide more predictable rates of return. You don't have the ups and downs that come with syndication and rental properties. Bragging rights. There's a lot of pride in being able to point at the Bank of America Jacksonville Tower or the JFK Holiday in New York, which are some of our holdings, and say, I'm a partial owner of that. I love to show off to our friends when we pass a building that the fund owns. They don't need to know that I only own 0.67% of that asset. Investors first. In my tax file fund, my investors get paid first. If they don't make any money, I don't make any money as the fund manager. It also pays consistent monthly distributions, allowing those near end game, which is floor 3 or the penthouse level, to pay their monthly expenses with cash flow. For a new investor, they can quickly see the cash flow hit their bank account. That eases the mental hurdle of taking a HELOC and helps them instantly cover the debt service and then some. This can also help a skeptic spouse who needs to see distributions drop into the bank account as soon as possible. A larger topic we often discuss during our live events. Most syndications pay out quarterly and only after a project is stabilized once our team has taken possession. Of course, everything in life has its drawback, and funds have their downsides too. Loose prospectus. Your general partner has a lot of discretion on how funds are spent, which is why, and as an LP, you want to understand and align with the fund's investment prospectus. Time-sensitive investments. The GP needs to pay attention to cash management, as inefficient use of funds will dilute everybody's investment returns. Lazy equity makes poor returns. This is why we micromanage the timing when investments are bought into the fund. Basically, once money lands on our side, the clock is ticking to grow it for you. Blind pool funds. In most funds, investors don't know what's exactly they're investing in. That means a shady operator can make bad deals without investors knowing. I see this a lot in the ranks of house flippers who create funds. One of these bad operators sold garbage assets to their own fund at 2 times the value, but eventually their scheme caught up with them. However, every fund is run as a blind pool fund where dozens of transactions are happening. I had a deal in 2022 where I identified a few assets that I wanted to close on. I included them in the investor memorandum so investors could check out the addresses of those assets and the strategy behind each of them. I also made a targeted prospectus identifying what our buying criteria were. We have also purchased 2 or 3 apartments and pooled them together because they complemented each other well. The downsides are mitigated by the same thing. Trust in your operator. That's why it's so important to do your due diligence. I'll give another examples of pooled syndications, which are technically a fund, but maybe you wouldn't think of it otherwise. I think most times when you think of a fund, you think of maybe a dozen or several dozen assets in the fund. But we've done it as small as we've had 2 smaller apartments put into the same deal. We had 3 properties in Huntsville put into the same deal. We actually just sold one of them where we more than doubled, and we retained the other 2 for future selling in the future. In that 3-pack that we had, one of the assets was more stabilized when we first bought it. One of them was just like a golden deal. And the third one was this little rougher property that we eventually got on the right tracks a year later. But as you can see, when these are pulled together in that arrangement, it can be blended to something, really nice there. So that's an example of how they somewhat complement each other. Pick the right operator. I self-identify as a middle market operator. As of 2023, our investor group has done over 60 deals with over 2.1 billion of assets. We're not the new guy anymore, and people like to work with us because we're very transparent. We get to know our investors and make sure our investors get to know us, because we know that it is not always smooth sailing. We throw closed events for new investors to test drive our organization and create accessibility for prospective clients to do their due diligence. If an operator isn't providing that opportunity to open up or admitting that there have been times of struggle, you should see that as a giant red flag. Other than that, the rules are the same as when you pick an operator for a syndication. Referrals. Larger, more institutional operators manage billions of dollars of assets, but they only work with investors with 50 million to 100 million or more net worth. Their minimum investments may range from $250,000 to $1 million plus. Most importantly, due to their high operational overhead, you pay hefty acquisition fees and you won't find a favorable investor split. Your returns as an investor will be lower. Roughly put, think of doubling your investments in 10 years instead of 5 years with a smaller operator. For some of the investors in our mastermind group, I might recommend diversifying with these types of institutional operators for sake of diversification, but as a general rule, I avoid them. On the other hand, working with complete newbies in the industry is also risky. It's hard to trust your money to someone without a proven track record. That's why I prefer middle market operators. We're not newbies and we have a track record of successful deals. We don't charge exorbitant fees like the institutional guys, and we strive to maintain a good balance between risk and reward for our investors. We don't have a huge staff like institutional operators do, but I believe this allows us to operate more nimbly with less overhead. I think back to the days when I was a city engineer. I had the long and painstaking task of bidding out and awarding simple contractor and consultant projects. When I was in the private sector, the process was not much better. Of course, the point was to minimize government corruption in awarding to the best low bidder, but it rarely led to the best value bidder. At the very least, it wasted a lot of time. Now that we are running our company, we have the freedom to make streamlined decisions to give the best value to the project and to our investors. At the end of the day, the hardest part is finding a middle market operator. Differentiating between new operator groups with a polished website and legit middle market operators can be hard without a network of other purely passive accredited investors. How much to invest in a fund? We established in Chapter 4 that you should never invest more than 10% of your net worth in one investment. Funds are different because each fund is actually multiple investments. If you get in on a fund with 5 properties, the chances of 2 or more of those properties going bad in a fund are very low. My more experienced investors start off by investing with a lot of different general partner operators. After a few years, they squeeze that down to 3 or 4 they like working with. That means they might have as much as 20 to 30% of their net worth invested with a single fund or operator, but it's one they've vetted and trust. Some of our investors join our Family Office Ohana Mastermind group to expedite growing their purely passive investor colleague group and cut down on the time needed to know where to put their money. Instead of the starter pack of 10 to 20% of their net worth in alternative investments in the first 2 to 5 years, those in our mastermind group quickly build relationships as part of the group culture. This sometimes gives members the confidence to invest twice the average in their first few years in alternative investments. Some invest individually over $1 million in the first year. Funds and syndications are reliable forms of investing, and one can get complacent on the floor 3 of the wealth elevator. After all, you can generate $15,000 to $50,000 in monthly passive income, but you might not want to stop with a mere 5 figures of monthly cash flow. You might want to move to the penthouse, and you can do it, but do you want to? As you get older, you have to ask yourself if it makes sense to continue playing the game. When do you get out of hustle culture mode? We aren't on the earth forever, and we don't get to take our money with us. What exactly is the point of carrying on? The answer, your legacy. Do you have kids to whom you want to leave a 7-figure advantage on their peers? What about the grandkids or the great-grandkids? Most of us are the first in our family to surpass 1 million net worth before reaching our golden years. Our children, Generation 2, often become high scholars, doctors, lawyers, engineers. But by the 3rd generation, things start to fall off the shelf for 3 reasons. We, the first generation, are probably not around to directly influence them like we did for the 2nd generation, who are our kids. The 2nd generation who are our kids, typically does not know financial education the way it is covered in this book and therefore cannot teach the next generation. The third generation had it easy and didn't have to fight for their wealth. Statistically, you can pass down your money and expect to last into the third generation. What you can pass on is your values, network, and knowledge. Creating a legacy is all about finding what you should be putting your time and focus on and sharing that with the next generation. Sure, you can create an irrevocable trust, try to define exactly how and when your money is passed down. Maybe they don't get a dime until they turn 25, or they have to do a random drug test to access the rest of the money. But the fact is, trusts are easy to break when you're gone and you've lost control. That's why your job is to be a good parent and financial mentor. I laugh with a lot of my longtime investors whom I knew back when they were broke on floor one, we call under 1 million net worth. I have seen their lifestyle and more drastically, their mindsets change. But one thing I can say is that money is a magnifier. Money makes stingy people even stingier and makes people with a generous abundance mindset more giving and positive. That's why teaching your values and creating a legacy is so important. When you do that, it all comes full circle. You have true wealth and the money to go with it. Net savings. Net savings is a critical statistic because it reflects the amount of money an individual or investor is able to save after deducting all expenses and financial obligations, such as living costs, taxes, debt service, and other financial responsibilities. It signifies the financial progress increase to your net worth you make by increasing your savings or reducing your expenses. I sometimes refer to this as your velocity. More traditional wealth building advice emphasizes frugality or managing expenses, whereas the wealth elevator focuses more on income. It gets lazy equity working and making more money for you and unlocking tax savings. Additionally, many of our clients earn substantial annual incomes ranging from a few $100,000 to well over $1 million per year. Many investors live in expensive states like California and have many children, so their elevated expenses can offset high income levels. This is where net savings comes into play as a loose indicator for comparing yourself with others within the wealth elevator ecosystem. Now, I get it. We've been all told not to compare ourselves with others, as most people are not on the same wealth building journey as those of us on the wealth elevator. However, when we examine our current clients who align with our mindset, investors in floor 2 and above save between $50,000 to $100,000 or more a year, while those in floor 3 and above save $150,000 or more a year, indicating that these individuals have managed to accumulate substantial savings. However, after a certain threshold of, say, $100,000 of savings per year, we see clients generally ease off the net savings, opting to enjoy their wealth rather than saving those extra funds to expedite the ascent up the wealth elevator. This gradual mindset and spending shift is exactly what we want to see after the third floor of the wealth elevator. Additionally, if you're making a lower household income of under $250,000 per year and are able to save only $75,000 to $100,000 a year, don't sweat it. You're doing fine. And this is where we get into it with these individual calls with you folks. We can tell you how you're doing in comparison with those in our community. And some of you guys may need a kick in the butt. And some of you guys need a pat on the back saying you're doing okay. Just relax a little bit. Enjoy life a little bit more. I coach families who are in that situation or who are bigger spenders, which drops them under $100,000 to $150,000 in annual savings. But I understand that quality of life is a consideration too. For example, if your kids are getting older and you want to spend that extra $20,000 to $50,000 a year on exceptional vacations and memories, then that sounds like a great trade-off. After floor 2, you will make more and more of these experiences for money trade-offs. A lot of clients on floor 3 or higher need to back off from extreme frugality once they reach that $2.5 to $3 million net worth level because they are beating their financial timeline to financial freedom. Planning your net savings strategy can be overwhelming. I'm happy to jump on a call to explore how you can plan your net savings for your wealth elevator investing journey. Join me via the club form at thewealthelevator.com/club and looking forward to connecting. Alternative investments in your portfolio. By this stage, what does your portfolio look like? Floor 3. You are a high net worth individual with more than $2.5 million in net worth. Passive investor plan 3. This is where the mind shift from scarcity to abundance happens, or at least needs to happen. You make enough passive income to live on, or if you don't, you just need to reallocate to the right assets. The future looks bright. You have more ability to adjust your gross income to under $200,000. In Chapter 8, I share even more advanced tax strategies for this floor. Continue investing more in alternative real estate. Increase your accredited investor banking, AIB payments, to $100,000 to $250,000 per year, legal. Your entity structure is in place. Continue to use an LLC as a holding company for your investments, especially if you're on floor 3 or above. Research more advanced legal protection strategies by networking with other legal industry experts and other passive investor colleagues. Retirement. Now is the time to actually fund your QRP. You know, all those retirement accounts that they told us to do in the beginning? In contrast, in my opinion, this is the point when you start to fund those legacy creation vehicles. But if it fits with your long-term plan, how much income do you need to have in the future? When do you expect to retire or work in some lower capacity for the long term? A great way to think about this. What would you do if you had to do it forever? Home equity. Consider improving your life with a bigger house or downsizing, depending on your life design. You can sell the house and invest the equity or cash out refinance. If you keep the house, consider transferring your home equity into your accredited investor banking account as discussed in Chapter 9. You now understand most of the floors of the wealth elevator. The basement, the rise through rental properties into syndications and private funds. Now you need to understand how to protect your money for the future. That starts with understanding taxes and asset protection, which is covered in the next chapter. Before we get on to the next chapter, I think most of the people reading the books will fall into this last section. You know, it's rather difficult trying to encapsulate the different strategies within so many different populations out there within the wealth building journey, or differentiating between floor 2, floor 3, as we did in these last few chapters. So for those of you guys who are listening to the audiobook, getting this extra commentary here, what I would really recommend is take a look at the table that we created with all the different floors and get your hands on the PDF copy and really go through the passive investor plan, the legal, the retirement, home equity sections, because I feel like I just glazed over the top a little bit. Unfortunately, I'm not able to customize and sit down with you in this format and say, you should be doing this with your home equity. You should be doing that with planning your future income. You should be doing this with using the passive losses to drive your income down and doing real estate professional status. But hopefully you're getting a high level approach and it's becoming a little bit more aware to you. And maybe another way of digesting this is reading the section a few months down the line when you've learned a little bit more, especially once you've met other people in this world that do the same stuff, and revisit the same content again. And that way it'll breathe new life into the content. But as you can get a sense, this stuff has really changed my life, going from a non-accredited investor working my engineering job and the strategy. It's, shifted multiple times. And now I have a perspective, right? And my job as part of the Wealth Elevator Curator is always to be forging ahead. What's beyond the penthouse level? What are family offices doing? And bringing the best practices back down to some of the lower level floors, but to streamline the journey to get there.